What is up guys, Joe here back with another video. Today I wanted to cover the FTX derivatives platform where you can sell both Ethereum and Bitcoin options for passive income. So this strategy is called covered calls. So you as an option seller are able to sell call options to the open market, and in return you get a premium just for selling those options. It's an easy way to earn income simply for holding your assets. And the cool thing is FTX allows you to do this for small contract sizes starting at 0.01 Bitcoin or 0.1 Ether. So you don't need a whole token to get started. You're able to trade and sell micro contracts to generate income. So if you're a long-term believer and holder of crypto, specifically Bitcoin and Ethereum, why not generate income while you hold your assets and collect monthly premium simply for selling these option contracts in the open market? So today I wanted to cover a quick guide on how to sell Ethereum option contracts on the FTX platform and start earning passive income. Let's get started. So first thing is first, what is a covered call? A covered call is selling a call option on an asset that you already own, in this example Ethereum, at a specified price and date. The payment you receive is called the premium. So for these type of contracts, obviously there must be an expiration date. So the technical term for that is expiration date, and this is when the option contract expires. Keep in mind, longer dates equal a higher premium. So if you sell a contract that is 2 months away, that's 6 months away, you can even do a year or longer, you will obviously collect a higher premium. So the strike price is the price where a call option can be exercised at. So if we look at this option contract here, for example, we have Ethereum and the expiration date would be 26th of August 2022, and this area here would be the strike price. So $3,000 would be our strike price. So if we look at the current price of Ethereum, it is hovering near the $2,000 mark. So for $3,000, that means we have about $1,000 more of runway to reach this strike price. So obviously a lot of headroom moving forward there. That's about a 50% gain from the current price point of roughly $2,000. And lastly, the definition of a call. A call is a contract between buyer and seller to purchase an asset at an agreed price. The seller has the obligation to deliver the assets if the strike price is met. So again, the theory behind covered calls is when you sell an option contract, you receive the premium. But keep in mind, let's say you pick the strike price of $3,000. So from $2,000 into $3,000, if you do reach the $3,000 price target before the expiration date, you're obligated to sell it at $3,000. So you're able to keep both the premium and the potential gains made along the way from $2,000 to $3,000. But also another benefit is if before this expiration date, if the price of Ethereum never reaches $3,000, you get to keep the premium regardless, and the contract expires worthless, and your Ethereum are released back to you, and you get to do it again and write another monthly contract for the next month. So this is an easy way to generate passive income, and you only have to write a contract once a month in order to keep generating monthly income. And here's another example, and here we're using a different type of asset with a different type of strike price. But let's say this was you and you agreed upon a strike price of $52 and the expiration date of 16 October 2020. So you're selling a call option to the open market, and on the other end you have a call buyer, and for selling that contract you get $50 premium. And just remember, the agreed upon strike price here is $52. So if you do reach that price of $52, you're obligated to sell it at that price of $52, and you get to keep the premium regardless. But if the price never reaches $52 before the expiration date, then you get to keep the premium regardless, and the option contract expires worthless, and you get to write a new contract for the next month. It's really a win-win situation for you. Cool, so now let's go over how to do this within the FTX platform. So the website here is derivs.ftx.us. This is available currently only to American customers, and you will have to sign up and fund your account. And don't forget, on the homepage there are a ton of educational resources, a ton of videos covering this method. I highly recommend you watch these in order to get greater in-depth look at how options work, and you're fully prepared to begin options trading. So once you're in the homepage, go ahead and sign in. And this will be your dashboard. So first thing is first, you also want to fund your account. So there's two ways of funding your account. You can either do a money wire transfer from a bank with American dollars, but keep in mind that is a slow process, or my preferred method is to actually deposit some Ether or Bitcoin into the FTX wallet. So very simple here on this dashboard page, navigate over to the right here under transfer and deposit and choose Ethereum. So on here, it would generate your unique FTX wallet deposit address. So what you would simply do is copy this address here and go to your favorite exchange such as Coinbase, and we have some Ethereum here. You would go to send and receive and select the amount of Ethereum you'd like to send. And remember, for FTX derivatives, each contract is a minimum of 0.10 ETH. So at the current time of filming, that's roughly 200 American dollars per contract. And under the to section, you would paste that FTX wallet address here and you would continue and send. And I will say one more thing, make sure you're sending this over the Ethereum network. Do not choose Polygon. FTX does not support Polygon deposits. They only support the Ethereum mainnet. Right, so now that you've funded your account, and as you can see up here, my available balance is 1.06 ETH. So with that being said, I have roughly 10 contracts I can sell under my holdings. Just remember, for Ethereum, the minimum required amount of Ether is 0.10 ETH per contract. So because I have one whole Ethereum, I can do 10 contracts on this one trade. And also make sure you're within this Ethereum tab, and within that you are under the options tab. Cool, so very simply, I know this looks intimidating, but this is easy to navigate. You would look for your strike price here, and like I mentioned, currently Ethereum is at 1,800, so we look for our current price point. We're somewhere in between here, 1750 and 2000. This is our strike price, and if you recall, our strike price is the price where a call option can be exercised at. And the way covered calls work, you always want to pick a price that is above the current price point. So anything at 2,000 or above, 3,000, 4,000 is suitable for our needs. And the technical term for that is out of the money when the strike price is higher than the underlying asset price. So for now, we're either going to pick 2,000 or 3,000 for our option contract. And next thing you want to do is pick the expiration date, right? And that's when the option contract expires. Longer dates equal higher premium. So for this example, let's pick 26th of August, 2022. And the expiration date can be found here under this section. So as you can see, this is 26th of August, 2022. And these are monthly options. So you get to write it once a month. The next one would be September 30, 2022. And if you keep scrolling lower, we have October, December, March 2023, June 2023. The list goes on. So remember, the longer dates equal a higher premium. So for example, let's say we picked the $2,000 strike price for August 26, and we look under the bid and ask. So for one whole Ethereum, which is 10 contracts, we would get between $48 to $80. But for the same contract at the $2,000 strike price, if we scroll lower, for the September 30 expiration date, we look at $2,000, and the bid and ask here, we'd either get $220 to $250. Right? Like I said, the premium keeps going higher the longer the expiration date. One more example, if you go lower for October, $2,000 strike price, and we navigate here, the bid and ask is between 281 to 382 for one whole Ethereum. So the bid is the highest price a buyer will pay for the contract, and the ask price is the lowest price a seller is willing to accept for a contract. And there is also a term known as the midpoint, and the midpoint is simply the price point between the bid and the ask. So if we navigate back to August 26th, again, $48 to $80, and the last price was actually sold at $60, which is roughly the midpoint. So at the time of filming, Ethereum is currently on a bull run, and we did touch the $2,000 price point recently. So I do think we will reach 2,000 again pretty soon. So with that being said, I don't think $2,000 in a week expiration is a good idea, because I have an inclination that it will reach the $2,000 price point. So in order to play it safer, because I don't want to sell at the agreed price of $2,000, the next level higher would be $3,000. So for this August 26th expiration at $3,000, I will net between $3.10 to $10.50. And what you could simply do is click on the ask here, and this would auto populate this contract into your position window on the left here. And for contracts, like I mentioned, there's 10 contracts within one whole Ethereum, and I do have one whole Ethereum in my balance, so I'll go ahead and type 10. So it auto-populates the data for you. The underlying asset I will put as collateral is 1 ETH. My premium is $10.50, and a fee that FTX takes is $1.50. And again, because this expires in a week, we don't have a long time for expiration. But if we chose the next month over, let's say September, we can scroll here and go to 3000 and click on the ask here. This would auto-populate this option in my position window here. And again, for contracts, I'm going to click 10. So for roughly a 45-day expiration in the next month, we will net $60 simply for selling that option contract. And $60 is great. Think of it like a crypto dividend simply for holding your Ethereum. And I don't think Ethereum will reach $3,000 in the next 45 days. This is why I'm playing it on the safer side. I do want to hold on to my Ethereum. I simply just want to generate passive income while I hold the token. So let's go back to our previous position, 3,000 here, and click on the bid, 10. And for people who don't have a whole Ethereum available, again, you can just simply do a minimum of 1. So that's 0.10 ETH. But for doing 0.10 ETH, that would only net you roughly 31 cents. So I don't know if it makes sense for you to do that. That's why I do recommend you trade with higher amounts. And let's cover 3 more areas here within our options chain. We have implied volatility, which is at 140%, our volume, which is 2, and our open interest at 2,300. So let's go over those definitions. Open interest is the total number of contracts held by traders as open positions. This is a good number to look at when you want to gauge the market interest. The higher the open interest, that means a lot of people are betting on that position. So that's a good indicator that a lot of interested buyers are at that strike price. Volume is the total number of contracts traded for that day. That means contracts that have been sold and closed during the day. And implied volatility is a metric that measures the likelihood of changes in the price. So the more buying and selling there is, the higher the implied volatility. But the good thing is higher implied volatility equals higher premium. This is a good thing for crypto. As you know, Ethereum and Bitcoin are super volatile. So the higher this IV, the higher premium you will net as a seller. And one more thing I would ask you to pay attention to is look at this order book. And this is a live market feed of current trades that have been happening. So we do have the bid side on the left and the ask side on the right. So again, you're asking for a price of $10.50. Keep in mind this order might not fill and you are bound to stock market hours. Derivatives function almost like an equity platform. So keep in mind these trades only execute during stock market hours in the United States. So that means if you're on the West Coast, the market here closes at 1 p.m. Pacific. But if you're on the East Coast, the market closes at 4 p.m. Eastern. Keep in mind this is not a 24/7 market. You want to place these trades during the day when the market is open. So if this position does not fill at $10.50, we can go back and modify the order and lower the price and probably put something lower like $10 until we get the option executed. So I'm happy with all this and we're going to sell this again, and for selling we will receive $10.50 and you'll get a verification screen. And again, your collateral here is 1 whole ETH for 10 contracts. And if it does reach the strike price of $3,000, you will be obligated to sell at $3,000 at or before August 26th. But if it doesn't reach that price, your ETH is released back to you and you are free to write a new contract for the next month. And the order was received, and actually the order was successful. And we have our confirmation screen here. You can click on that. Cool, so that covers a quick guide on how to sell covered calls on the FTX platform and generate income. This is an easy and straightforward way to earn money simply for holding your tokens. I am long-term bullish on both Ethereum and Bitcoin, so why not generate income while you hold your position? And I do recommend you check out FTX's knowledge base regarding everything options trading at support.ledgerx.com. They have a ton of resources and videos explaining the covered call technique and other strategies. Definitely want to educate yourself when executing this method. So what do you think about options trading? Are you a fan? Do you like covered calls? Let me know in the comment section. I hope you found this information helpful. If you have any questions, please leave a question in the comment section. I'll be happy to respond. Don't forget to like and subscribe. I'll see you on the next one.